We start off tonight with that historic jobs report of more than 20 million people put out of work last month alone, the worst monthly loss on record. But markets rallied anyway, with the Dow ending higher, nearly 2%. And check this out, the volatility index dropping below its 100-day moving average for the first time since February. So on a day where we find out the U.S. economy just lost a mind-blowing 20.5 million jobs and unemployment skyrockets to nearly 15%, you'd think the stock market would be down, but it didn't. So Guy Adami, what do you make of that?
One would think, and one would be myself, absolutely. You know, look, I definitely saw the move back to 27.90. We talked about that for a while. Kudos to Tim, who's been, I use the word all the time, steadfast in his belief that the pain trade is higher. And here we are. What do I make of it? Well, I guess it is as simple as when liquidity is sloshing around, don't fight these central banks. But I'll just caution you, it's good that we'll be talking about Disney later, because the market's clearly in my favorite area of Disneyland, which is fantasy land. And at 33.93, when the S&P 500 made an all-time high, we were talking about a 21.5 times multiple. That's assuming $160 worth of earnings. If you give the market 130 now, which is also fantasy, the market's actually more expensive today than it was at all-time highs. I think it's just something to think about as we head into the weekend, Melms. Something seemed to change, though, about the rally that we saw today and yesterday as well, Tim, and that is the breadth of this rally. It wasn't just, the five biggest tech stocks making their way. They did do quite nicely, granted, this week, with info technology becoming positive for the year. But we did see, for instance, the Russell up strongly today. Equal weight S&P 500 did 1% better than regular old S&P 500. So what do you make of that? Is that more positive, perhaps?
It's absolutely more positive. Brent and crude prices are up another 5%. So, this isn't Space Mountain either, though. I think you have a case here where you have still a very much a chasm between the haves and the have-nots of the COVID-19 stock market. And then you kind of have Main Street versus Digital Street, right? Or, Electric Avenue, as Eddie Grant said. You have these Main Street stocks, which are banks, are industrials, are obviously, the direct hit on COVID-19, airlines, cruise lines, et cetera. But then you have what we've talked about, which are the FANG stocks. And ultimately, I do think you have a case here where we're starting to get a little bit more confidence as some of the country reopens. I think we're going to see this in cycles. And I think this is, again, partly just about market positioning. I still think there are a lot of equity shorts and underweights. If you look at the positioning of the SPY, for example, as an ETF, it's still relatively near where it was at the bottom. If you look at sentiment indicators in terms of the retail audience as opposed to the professional audience, they are basically where they were at the lows of March in terms of their bearishness. And I do think that these are factors, even though I don't think equities get away from me on the upside over the next 2 to 3 weeks. We need to see the company open up, and then I think some realities are going to tick back in. But I don't see a mass run for the exits because, in fact, I still think a lot of people are not here.
I think the other question, too, BK, is the jobs report that we saw this morning, is that going to mark the worst of it? I don't know. Is there going to be another wave ahead, for instance?
Right. And so that's the biggest question out there. Are we looking at temporary or permanent job losses? And so I think that'll go to what's going on in the stock market. The other thing that you have in the stock market here is that the Federal Reserve, and this is not to bash the Federal Reserve, but they've taken away any price discovery whatsoever. So the stock market will increasingly get disconnected from the real economy. But I think going forward, if we look at it and say, okay, in 3 months, in 6 months, what's the unemployment rate going to be like? Does it permanently stay high at 10% or 12%? Then you're going to have erosion of earnings. Then I think the stock market might start to think about, okay, this is not the environment that we had anticipated. I think it's going to be very hard for it to make new highs, but I've been proven wrong before.
At the same time, maybe we are catching a glimpse of what lies on the other side. Guy, it is a Friday show. I don't want to be a complete Debbie Downer on a Friday as we close out a very strong week for the markets. No. Take a look at this chart or imagine it in your mind because you guys are at home. This one was given to us and tweeted out by Dr. Scott Gottlieb, the former FDA commissioner. And this shows effectively the U.S. daily positivity rate. So even though testing is becoming more widespread, the positivity rate has gone down, which shows that actually things might be getting better. There are more tests being given, and there are fewer positives still. Isn't that a massively bullish, optimistic sign for us, Guy.
Yeah, well, if the only reason you believe the market is here is because of COVID and things associated with it, then I guess the answer is yes. And clearly, I think we're all wishing for the day where, this is eradicated, much like smallpox was, for example. But I don't think we're that close. So, until we get a vaccine, it's very hard for me to get, all giddy in terms of where we are in the health front. But I understand what people are looking at. I also just want to say that it's so unfortunate for all those people named Debbie out there that Downer has to be associated with the back end of that. Why not Denise Downer or Donna Downer, which is actually better if you think about it, but I digress.
Or Dan Downer, in honor of Dan Nathan. I thought of about
Dan
that many
Downer,
times
yeah.
when I say
Dan
Debbie Downer.
Downer.
I wonder why the Debbie Association out there doesn't contact us with hate mail. We've got Jeff Mills, thanks to technology. So what you make of this week's action, Jeff, which is very strong and broader than past moves higher?
Hi, Melissa. Yes, finally made it, thankfully. I'll go back to what Tim said. And look, I've been pretty negative throughout this entire rally, but it does seem like if you look at flows out of global equities, flows into money market funds, CFT positioning, still pretty net short. So I don't know that the spark is necessarily there for a major and violent move lower at this point. I think we got past the week of big tech earnings. That was a particularly concentrated area of vulnerability in the market. So if there was a big disappointment, that could have been the catalyst. But again, past that. So near term, I think the pain trade may actually be higher. But looking out past a few weeks or maybe a month or so, I still think that we're going to be dealing with the economic fundamental issue. It seems like the data is just so bad. I mean, we're going to be inventing new charts to try to capture the data that we're getting month over month. It's really just unbelievable to see. I think the market's having a hard time internalizing that data and figuring out what to do with it. So by and large, it seems to be ignoring it. And I think ultimately that's not going to be possible. I think about what 2021 earnings look like at $165 or $170 a share, which is the forecast right now. That just seems way too high to me. So as those estimates start to come down, the multiple that the market's going to have to carry to support markets where they are today or higher is just going to be too high, I think, to sustain current levels. And I also don't believe that we're gifted some high multiple just because interest rates are low. So we've taken a little bit of risk off the table for our clients just in anticipation of additional volatility in the coming months.